welcome back. Today we will continue the Module 6 chapters. Today is corporations, organizations, stock, transactions, and dividends. Obviously, we know what a corporation is. We know them by name, but it's important to be able to correctly define what a corporation is. And here is your definition. We are talking about corporations mostly in this particular course. And a corporation is a legal entity. It is not the same as its owners, and can be sued. It issues stock for owners. It can acquire and own property on its own, and obviously it can even have liabilities and enter into contracts. Shareholders or stockholders are owners of the organization. There are common stock, there is preferred stock, but the true owners of any organization that's a corporation is going to be the common shareholders. Corporations that have their stocks traded in public markets are going to be public corporations. Privately held organizations, they're non-public organizations as well, and they're corporations, and they're a small group of investors mainly that do not openly list their stock for sale. Corporations do have limited liabilities, obviously limited to the owner's investment in that organization. Individual owners are shielded from the debts of the organization as well, so they are protected. Corporations do have board of directors, and again, this is all characteristics of corporations, which I believe many of you are quite frankly aware of. This is just giving you some more information. They do pay federal taxes, and dividends that are paid to shareholders, they are taxed as well. Double taxation is characteristic of a regular C corporation. This does not apply to limited liability companies or S corporations. So forming an organization like this, you will obviously need to work with an attorney, and they will help you write the charter and submit it to your state, because each state has the ability to form corporations, and the organization will be handled through a set of bylaws of handling their affairs, and again, articles of corporations granted by the state. Forming a corporation is not really expensive. Obviously, you will have to pay for an attorney to draft the articles of a corporation and file it for you. Any filing fees, which may very well be annual, and promotion fees and taxes. Initially, setting up a corporation could be as much as $1,000 or as little as maybe $500, depending on which state and the fees associated with that state. So all these costs are going to be considered organizational expenses, and it's just letting you know, we're just organizing the organization. We're getting things set up, so it's not anything else other than that. Sources of stockholders' equity is going to be paid in capital, which is going to be the amount of money paid in excess of what the common stock's par value is. But it's also going to be retained earnings, and you know all about retained earnings because you've been working with that with your project. So the number of shares that our stock can issue is called an authorized. They are authorized to issue. Outstanding are the stock that is in the hands of shareholders. That's going to be your outstanding stock. And again, just know these terms. They're not very difficult. And in fact, many of you may already know what they are. So stock is assigned a dollar value most often, not always, and it's called the par value. That's going to be assigned at the time the charter is submitted to the state for consideration. So it's important to have legal capital. Knowing what that is for purposes of accounting really does not really make a lot of difference. The only time that it's really concerning is when you have to liquidate your stock and you're paying for stock or paying back stock in excess of what the par value is, and that becomes an issue. But in this class, it's not going to be something that you're going to see very much of. Just understand what the concept means and how it is applied in the corporation, which is very different from partnerships and sole proprietorships. So, owners of the stock, common shareholders, have a right to vote. They have a right to share in distribution of earnings, and they have the right to share in assets upon liquidation of the organization. Obviously, we told you, I just mentioned common stock and preferred stock. The true owners of the organization will be the common shareholders. Preferred stocks gives you preferential treatment in regards to dividends, and generally they're going to be paid much more. and that's important to know. So understanding that preferred shareholders are not owners of the organization. They do not participate in the running of the organization, and they do not elect the board of directors. Payment of dividends, again, the board of directors are authorized to declare dividends, and when it's declared, they have an legal obligation to pay it. It doesn't matter when it gets paid, or it just matters that the board of directors have declared it. And the moment that it's declared, the declaration date is the date that the liability needs to be recorded on the financial statements. Cumulative preferred stocks means just that they have not only preferential treatment, but they can also get past dividends that were not declared in prior years. Very important. And then also in arrears is important as well. So the common shareholders will have to wait and get only what's left over, because the preferred shareholders get the right to their shares of stock, their dividends, but they also get, in some cases, any dividends that have not been declared in previous years first, before common shareholders can get their money. So stock is issued for each class of stock. Generally, it's only going to be one class. I mean, I think I've only seen a number of companies, handful of companies that have more than one class of stock, but it's usually just one class of stock. And this is generally a type of transaction that will be recorded. Again, this is one form of fundraising for an organization. They can raise money by issuing debt, or they can raise money by issuing equity. In this case, we're talking about equity. So if an organization is authorized to authorize 10,000 shares of 100 preferred stock and 100,000 shares of $20 par value common stock, the corporation issued 5,000 shares of preferred and 50,000 shares of common stock at par for cash. Very important. So what we want to do is we want to find out how much money did they actually receive. And you want to just do the multiplication. If they are going to issue that share, so 5,000 shares at $100 each, that gives you 500,000. Then you take the $50,000 shares, 50,000 shares, and you multiply it by the, let's see, $20 per share. You get the $1 million. And again, this is just a very standard entry, and we are assuming at par value. We're not going over par value, and we're most certainly not going under par value. So that's the entry to record both equity items, and then the difference is going to be cash. Sometimes, and often actually, stock is going to be issued at a price that is different from its par value. Now, if it's below par, we could talk about that, but I want to talk about it when it's over par value. Again, you're going to record the transaction for common stock at its par value. The difference of that amount that's paid to for the stock is going to be in the additional paid-in capital. So when they pay more, it's because they expect to earn more. They expect to earn more. They expect to be able to benefit from that organization's financial position. They're doing very, very well. They're very strong, and they're willing to pay a little bit more than what the par value is. And that's generally what happens. So if there is a difference, any difference in the amount paid for common stock that exceeds the par value, is going to be lumped into this paid-in capital in excess of par account. So, and the same is true, you don't always get cash for your stock. You can also get land, building, and other type of assets for the stock. And if it can't be determined, then obviously we're going to use the value of the stock as the amount to attribute to the asset that's being acquired in exchange for common stock. And you know this because you have transactions in your project that is an asset being received of equipment in exchange for common stock. There are cases where there are no par value on your stock, and again, the stock is going to be just per share. It's going to just go to it's just going to really go to common stock. Accounting for dividends. When there is a declaration, we're going to show on our book there is an obligation to pay the shareholders dividends. Now, generally, we pay dividends in a form of cash, but not always. Sometimes dividends are paid in a form of another share of stock, and we're not going to go into those details, but just note that cash is only one way to pay for dividends. Sometimes you pay for additional shares of stock. But in any case, when you make a dividend payment, you're going to reduce retained earnings because you are paying the resources. You're actually giving them their money because they earned it on the profitability of the organization. So when the dividend's declared and when you're closing out your books, you're going to be making certain that you debit your retained earnings and you credit your dividends to ensure that retained earnings is paying for the dividends that has actually been paid to your. Just to reiterate, when a dividend is declared, we have to record the obligation to pay it. When it is paid, we reduce our cash clearly, but we most certainly have to reduce retained earnings. A cash dividend is paid, and again, they must be, there are some rules with this. You have to have enough cash to pay it. You have to have sufficient retained earnings to cover it, because if you don't, it's called a liquidated dividend and it has tax treatment. So we don't want to do that. We don't ever want to pay more than what's in our retained earnings. And it has to be an action by the board of directors. So if there's enough money in your retained earnings to declare a dividend, then you're going to remove or take that retained earnings and cover the actual dividend payment. On the screen you'll see that there are 3 dates that we are concerned about in dividend declaration. We want to know the date it was declared. We want to know the date of record, and we want to know the date of payment. The date of declaration is when they are authorized. The board of directors authorized that the dividends are going to be paid and what amount and all those details. The date of record is how many people are on the roll of stockholders as of a point in time. How many people were on there? Who are they? So the date of record could be January the 1st. All of the people who are on, who had purchased our stock as of 1/1/2019, that's called the date of record. And they are going to be the individuals of the recipients of the dividend payment. And the date of payment. Now again, the date of payment is when you write a check, if it's a cash dividend. And here is my summation of what I just said here. Again, we want to make certain that you consider the date of payment when you're recording these transactions in your project. The date of payment is going to be when the check is written to your shareholders. Sometimes dividends are not paid in cash. They are paid in stock dividends. And again, this is most certainly something that can be done and has been done. And I have received, personally, I have received stock dividends as opposed to cash dividends. I quite frankly prefer cash, but it's up to the board of directors to decide what method of payment they decide to pay these shareholders. Now, stock dividends does not change assets or total equity. Basically, it just gives you more of a proportionate interest. I mean, see, what it does is it just takes the number of dividends that you have, it increases it, but it kind of increases the shares you have, and then it decreases your ownership, because it kind of, it's like adding water to cola or something you're drinking. It's just more or less the same amount of sodas in the bottle, but it added another fluid content to it. I don't know if that's really a good explanation, but stock dividends really is just like a debit, like a memo entry. We gave them stock in exchange for retained earnings. So in the end, the equity section doesn't really change. It just stays the same. It's just different lines on that section. One goes up, one goes down, but in the end, the bottom line is basically the same. However, a stock split does, in fact, change the number of shares. So if you think about them in this way, when you have a share of stock and it goes from 1 to 2, your proportionate shares, it reduces your value of your shares, because it's like dividing it in pieces. Whereas issuing of stock dividends doesn't change the equity. It just moves it just basically reallocates, if you will, the equity. So the overall change in equity remains the same. So we don't particularly like to issue stock splits because it reduces your market value of your stock. However, it does have the ability to attract more investors. And again, if you are looking to increase your cash and you're raising money and you're using equity to do so, these are options that you have available. In the case of stock splits, again, no interest required, but we have to disclose this information on your financial statements. Treasury stock is when an organization buys back its own stock. That's simple as that. And they do it for a number of reasons. And they can do it based on how much it costs them, or again, they can do it the par value method. And again, either way of the methods is none of which are bad or difficult. Just your job would be to understand the two different methods and how they're computed and how in the presentation on the financial statements. So here is just the methods of how you can report your stockholders' equity on the balance sheet. Again, with your homework, you might need this information. I would certainly have my book open as I'm going through because these are kind of obscure type of concepts that are not usually or uniformly transacted on a daily basis. So these are kind of these transactions that don't happen very often. So relying on your textbook to help you through is going to be helpful in this particular case because it's something that's very, very rarely used. I would say when you're recording your transactions in your project, you're going to see your retained earnings. You're going to see your common stock. You're not going to see paid-in capital because everything that we've done was all on par basis. We didn't do anything over or under par. So you're not going to see that kind of level of sophistication on your project. So in this case here, just understand the two different methods and how they're reported, and really just the presentation really I think is more important than anything. So what is retained earnings? It's going to be a separate account for sure, but it does tell you what has been kept back, what the organization has held back from distributing to owners. Essentially is that. So it's going to be reported in the retained earnings statement, and I think that's going to be one of the statements that you're going to be preparing in your project. It can also be reported in the combined income and retained earnings statement, and it can also be provided in a statement of stockholders' equity, all of which are valid reports, and it really does depend on the organization and how they want to present the information. And again, this is something that you will be most certainly interested in. How do you prepare a retained earnings statement? Because you will be preparing a retained earnings statement. And it's going to have your net income that's going to be added. It's going to have your dividend that's going to be subtracted, and your ending to arrive at your ending retained earnings. Obviously, for paid-in company, it's going to have a zero beginning retained earnings because there's nothing happening, but you will be reporting your other transactions to come up with your ending retained earnings. Obviously, retained earnings is going to be restricted. It's going to be a separate line item on the balance sheet because it has to be clear to anyone who looks at your statement that certain part of retained earnings is not going to be free for use or distribution to your owners. And it most certainly has to be disclosed. They have to be legal, they have to be contractual, and sometimes some are discretionary. But I would say most often the legal and the contractual are going to be the drivers for restrictions in your retained earnings. And this gets into more intermediate, but there are some prior period adjustments that may require you to adjust your retained earnings. If you notice that you change your depreciation or something like that, you don't have to make these prior period adjustments. But if there's a correction of an error that have an effect on your earnings, you have to make these adjustments in retained earnings. And again, this is all intermediate, which I don't believe is going to be focused heavily in this course, but you need to know that there are times when retained earnings is going to be adjusted. And why is it adjusted? Not for dividends, but because of an error or prior period adjustments. So statement of stockholders' equity, and again, just know what they are, how it's computed, and what information is going to be shown. One of the things that are important in decision making is going to be the earnings per share. This is going to be a common calculation that's performed, and it's also shown on the face of the financial statements and the income statement. And here's the computation. It really does allow owners and others to know what is their earnings per share. And this calculation, although it seems to be straightforward, it can be complex, particularly the denominator. The denominator is going to be harder to calculate, because if you're transacting a number of shares and sales and purchases, the average number of common shares may very well be more complicated to compute. But all in all, it does give you the earnings per share, and you can compare that with other organizations of similar size to get an idea of how much each of your shares provides in earnings to you. So the earnings per share is going to always show the basic earnings per share. Sometimes the earnings per share may very well be diluted, in which case you have convertible stock transactions that have to be considered in those calculations, in which case you'll have diluted earnings per share. It has been an awful lot of information that I have been providing you. Please note that this course is not going to be emphasizing on the more complex intermediate level items. It really does allow you just to get an idea, a taste of the complexity of accounting for the equity section of the balance sheet and all of the details that go into that. Your job will be just to get through this chapter and understand the basic concepts of stockholders' equity and how to record these various transactions, and the very presentation of the financial statements as relevant to the equity statements. Thank you very much for listening, and I will most certainly talk to you in the next video.